Hello, I'm Ted Seides, and this is Investment Management Operations. This show explores the inner workings of the most sophisticated institutions in the industry. Through conversations with executives across operations, compliance, legal, and finance, you'll hear how key operating partners run their businesses in an ever-changing and complex investment landscape. You can join our mailing list and access Capital Allocators content at capitalallocators.com.
I'm Scott McDonald, and I'm your host. My guest on today's show is Taimur Hyat. Taimur is the COO for PGIM. PGIM manages over $1.3 trillion in equity, fixed income, real estate, alternatives, and multi-asset solutions. Being a strategic COO is the wave of the future, and Taimur provides some great insight on how he does it. Taimur shares his evolution from doing development economic research to consulting at McKinsey before landing in asset management with stints at Lehman Brothers and Credit Suisse Asset Management. Taimur shares his thoughts on understanding the moving parts of the big picture being just as important as the hard ops that happen on the front lines. PGIM's size and scale creates an opportunity to uncover around-the-corner ideas they call MegaTrends. Taimur shares the importance of how different cultures, markets, and regulators work together and what it takes to bring a global mindset to your work. There is a lot here on what it takes to be a COO version 2.0, so take a listen. Please enjoy my conversation with Taimur Hyat. Taimur, thanks for joining me. I'm excited to have you on the show to explore how to be a strategic COO as well as some other topics. But first, I'd love to get a little background on your journey to PGIM.
Absolutely excited to be on the podcast. So the journey to PGIM is a story of two parts. I was an academic for many years and was studying development economics, lecturer at Oxford, worked for the UN on really helping the poorest of the poor and understanding how do you get people out of poverty. And that was my life for a long while. And at some point, I think I grew a little disillusioned with the impact I could make in academia versus what I could do in the corporate world. And it's really because academia was, you end up using data that's 5-6 years old, and it's always looking out of the rearview mirror rather than what's ahead. In England, you work in these very cold 16th century or 17th century buildings, pretty much on your own. There's not really a team around you, so there's no one to bounce ideas off. And a lot of academics is about being the biggest fish in the smallest pond so that you own your space rather than all the cross currents and linkages across different disciplines that really give a full understanding of the world. Is even an operations role, it's often about understanding people. If you're in HR, you've got to understand the business strategy. The academic world needs to be more linked than it is. And then finally, I was in economics and development economics, and it had become way too much around econometric sophistication rather than a link with things that can actually change policy and change things on the ground and link to reality. So I made the move from a life in development economics to New York. I was in England before then and joined McKinsey in early 2002.
What were you focused on at McKinsey from a client-based perspective?
So I'd always thought that my economics background prepared me for anything because every part of the universe should be about supply and demand and how humans balance that. But McKinsey quickly glommed on to the particularly deep interlinkages between an economics background and an econometrics background and financial services. So even though the brochures talked about working with aid organizations in Africa and helping the New York Fire Department, and of course, McKinsey did all that, where I was directed very much and soon found I was very passionate about was the insurance, asset and wealth management space, and particularly asset and wealth management and some of the places they came together. So I spent a lot of time on the knowledge effort and the work, Scott, around retirement, for example, and how do you create retirement products that in those days help with the accumulation journey? How do you help people with default solutions and other particular retirement products that can help them save enough assets for their retirement? But also very much in wealth management, the different channels, I think direct to consumer and digital was just rising at that point. And then I really found that my heart was in the asset management and wealth management space. And that's where I drew the most passion and energy from work.
What was the main driver to decide to actually be on the inside away from McKinsey?
I've always thought at some point when you're a consultant, it's fun to be a photographer, but sometimes it's the right time to be in the frame. And I also recognize that real change in companies doesn't come just from a 3-month engagement or from a perfectly crafted analytic story about what a company needs to do, but it's about moving people, changing mindsets. It's about connecting the dots between different parts of an organization. And I just discovered that it was much harder doing that while in a consulting seat outside the company, not being an insider, so to speak. So I felt it was time that I've got this incredible toolkit, this incredible arsenal of skills, but they could be better deployed inside a company with the long-term repeated interactions that allow you to build trust, that allow you to understand people dynamics, that allow you to keep pushing on things that sometimes are multi-month or even multi-year conversations. And that can only happen within a company rather than as a trusted advisor outside.
What was the most difficult part of transitioning in-house?
It's a great question. I think one is the responsibility for execution from being in a role where you're advising and then stepping into a new situation and advising somebody else. But now you're on the hook for actually delivering. And that's a different mindset. Again, the toolkit I think that strategic consultancy provides is very good for that. But owning execution all the way through is a new skill. I think the second piece is this point around repeat interactions. You now have to build a relationship across the organization, from the security guard at the door to the executive assistant to a new analyst joining to middle management to the CEO to the board, and really understand the motivations of that entire stack of people who ultimately drive a company's success, and figure out how you inform them, arm them with information they need, help them participate in the journey that you're taking a company on, whether it's a small initiative or a company-wide transformation. And those are skills that I think are fairly new when you join a company than when you're outside. And then I'd say every company is a bit like a country in a sense. It's an imagined construct. It has its culture, it has its history, it has its legacy, it has the stories that people tell each other that passes on what that company means. And that's an imagined construct, which is why I think in some companies it fell apart a little during the pandemic when people didn't gather in a single space. Germany wouldn't be Germany, or India wouldn't be India necessarily if it was all a diaspora all over the world. What that company means, I think understanding that and taking on that passport and saying, I'm a citizen of this company, it's a very different mindset from when you come in as a consultant. So that was an important transition too.
That's really interesting perspective. And then what was the first role that you took moving from McKinsey?
So I joined Lehman Brothers as head of strategy for the Americas, so Latin America, North America, Central America.
I would suspect that coming from McKinsey and given your background, you probably had a lot of options, a lot of different companies that you could consider. What attracted you to Lehman Brothers at that time?
I certainly felt that Neuberger Berman, which was the asset management house there, had lots of growth potential and was doing lots of exciting things. George Walker, who ran that business, was fairly early into the idea of multi-asset class solutions and connecting the dots and building capabilities across both the traditional asset management public sector and the private sector, and was doing quite a lot of innovative things there. I wanted to understand the investment banking world more deeply and felt that ultimately it has fairly deep connections, as every CEO knows, into the asset management world, the sell and the buy side of the same trades. And the company seemed ripe at that point for more growth opportunities and things to explore.
And then in those moments when you go through this distress cycle, that accelerates learning and experience. Any takeaways that you could share from that moment?
Probably the most important lesson it taught me was resilience. And you see how different people react to stress, and those who don't take it well and become disengaged or stop communicating. You can see the panic or the fear on their face. So they're looking at the news broadcast all the time rather than thinking what are pathways to create the best outcomes for clients as fiduciaries or as trading partners. And then you see the people who are able to withstand that stress and stay calm and think about the future and keep the clients central to how they're making decisions rather than themselves. And I think all that happens in a really heightened speed and makes a much deeper impression than in good times. One's ability to absorb all that becomes much more heightened because one's living that moment perhaps more intensely than moments when everything is going well.
At this moment in time, does that make you just reevaluate how people assess problems?
I'd say a second learning from living through the global financial crisis more broadly and being within one of the firms impacted was I think I've developed a much deeper and nuanced appreciation of risk, regulation, and how all those work together and how the financial ecosystem as a whole and the role of trust and belief, how important it is. So how a counterparty is going to react and at what point do they say this is over versus not, and how somewhat random that can be and how important information flow can be in that time. How important the role of central banks and other regulators can be in connecting the dots between different firms became much more apparent to me in that time. Understanding when you can take risk and when you can't take risk, and what is an ambition that is ambitious but where the tail risk is a manageable risk for your shareholders or equity holders, that became more apparent to me. So you end up taking a lot of very important lessons. What I've tried not to take is that it's not that you should become so conservative and it's not about risk taking, but it's about balancing risk and reward. I think it's also about what are you aspiring to be and what are the necessary conditions for that aspiration to become real. And I think at times during the global financial crisis, the companies that didn't make it through had aspirations that their equity bases, their capitalization, their liquidity profiles didn't really afford them to do. And perhaps a certain euphoria and bubble-like characteristics and impatience had crept in, whereas the same goals might have been achievable if you took a path that maybe took a few more years, but protected you on the downside more along the way.
And then where did it take you after Lehman?
So I spent the next 5 years as a global head of strategy and product development at Credit Suisse in the asset management division, essentially creating a strategy framework and a product development and product management framework across Credit Suisse, where one of our key clients was the Credit Suisse Private Bank, now the UBS Private Bank, and in terms of selecting which products to launch versus which ones not to, and then all the vehicles and structures that clients around the world need to fulfill their access to an investment strategy.
And then what drew you to PGIM?
So the CEO was a good friend from the McKinsey days. We'd worked a lot in that retirement journey that many of our financial clients were taking in terms of building retirement security for Americans and citizens around the world. And we were having lunch one day and he said, I'm embarking on a really interesting journey. We have this hidden jewel. It's one of the largest asset managers in the world that no one knows about. It has incredible alpha generation and investment capabilities. It's got the right separation from its parent company where you can really let investment management talent thrive. And yet there is lots of opportunity to modernize and grow this business and take it into what a modern, top-notch, best-in-class asset manager looks like. And I need a partner on this journey, someone who can help me execute on my plan, say no to any ideas that maybe we aren't ready for, don't make sense, and then help execute it. And it just seemed like a really exciting journey. And as I discovered PGIM more thoroughly and talked to investment managers and portfolio managers and business leaders there, it did become clear to me that this was a business that at that time, Scott, was about 550 to 600 billion in AUM. 85% of its assets were with US clients, mainly public and corporate pension plans. And it had very siloed boutiques that focused on a single asset class and really communicated with each other. And I immediately liked many elements of this model and elements that I thought we shouldn't ever change. And the most important of that was the investment process and philosophy of each boutique was separate and appropriate and distinct for its asset class. And we weren't trying to create some fake house view that linked private credit and real estate and agricultural equity and public fixed income and fundamental equity. And that we weren't trying to impose a single culture, but celebrate the diversity of the cultures and the different kinds of people it takes to succeed. So the challenge, which was an exciting one and one that I accepted, was how do you preserve what is unique and special for our clients in this multi-manager model, while also modernizing it in a way that you can take advantage not just of the depth and expertise, but of what scale might bring, and of a more concerted effort to say, okay, where is the puck going? How are clients evolving and how can we grow to meet those changing needs?
It's really fascinating because there's just a lot when you're trying to invoke change, but there's just so much inertia in our industry. Any guidance or suggestions on how to get people to think about what do you keep and then what do you shed or change?
Our approach, which has worked really well over the last 10 and a half, 11 years that I've been here, has been one of always offering a menu to the leaders of our investment businesses. It's never a prefix. We've said, here's a menu. It's a broader menu than you might have seen before. Here's the rationale for why it might make sense. And all our 5 or 6 big scaled asset managers are all big enough that they don't have to do this. But if you choose to do so, we can do this collectively with more scale and power and resourcing than you might do on your own. And by not making it mandatory, but making it a choice, and by laying out the case for why they might participate, but why they might also choose not to participate. So there are 2 kinds of opportunities that slip between the cracks of a multi-manager model like PGIM, where you have investment boutiques that come together when they need to, but have very separate investment processes. And one is things that require connecting the dots between different asset classes. And a good example is target date funds, which we launched, but you could argue should have been launched 10 years before we did so, because we had at that time one of the largest retirement record-keeping platforms in our parent company, Prudential. We subsequently sold it to Empower. And we had a asset manager with all the building blocks for target date fund, but we never did that. There are other examples of the same kind, and we've actually built a dedicated solutions business for insurers and pensions. A second example, Scott, is where it's too small for any one team to do, in our case, for one business to do. So Australia is a good example. Does it make sense to set up an office in Sydney, meet all the regulatory requirements, create all the right fund structures to be in Sydney if you're just running a private credit business or just running fundamental equity? But at the scale we had at PGIM, we could do that. And that made a lot of sense. And we set up an Australia office and then the businesses joined. We said, build it and you have the choice to come. And they came. And finally, I think we were brand, even institutional brand, because of our assets, about 1.1, 1.2 is institutionally connected or institutional. Brand was increasingly becoming important for institutions. After the global financial crisis, clients were consolidating the number of relationships they had. They wanted people to provide a broader suite of solutions or strategies, even if they were getting single sleeves, but just provide more to me, provide more value to me, and just simplifying their home offices as well, simplifying their asset management partners. Brand was becoming more important as a thought leader. Really have a conversation with the client around what are the pebbles in your shoes and how can we help you with them? Who can be a first call for a client when the chief investment officer has something on their mind that they're trying to solve for their board or noodling over.
Tell us a little bit more about your responsibilities at PGIM.
Every year, we have 4 to 6 priorities of things that we need to do differently or change, strategic priorities. Some are single-year priorities, and some are multi-year priorities. And my job is essentially to work side by side with the CEO, with David Hunt, to execute on those priorities in terms of collaboration, connecting the dots, figuring out pain points and bottlenecks to make those single-year or multi-year goals happen. And that requires working effortlessly across business leaders, client-facing teams, and the functional areas that I oversee. So rather than a list of deliverables by function or area or technology or ops or legal or communications, it's really about what are the strategic priorities. And then I know I have incredibly capable leaders within each function, each business. How do you conduct that orchestra? These days you have lots of self-conducting orchestras. If that's happening, great. But where can I jump in to help conduct the orchestra? And in particular, I've seen, and maybe this is true of other asset managers as well, we are quite good at creating the new ship and launching it from the port. But where you really need intense focus is making sure the ships you've launched get to their destination, that whichever islands or new continents you have to discover, that the ship's getting there, it's being buffeted in the ocean, new storm conditions develop. How do you react along the way to opportunities that pretty much every asset class I can think of is large and growing, and many make lots of sense for different client bases? How do you execute against that? And how do you create success and bring the right talent, create the right frameworks, create the right operational infrastructure, the right controls? That's the challenge. So that's my broad role. More specifically, I oversee about 650 people across all the functions that are the backbone of an asset manager, including operations, marketing, communications, innovation, ESG, government affairs, and perhaps a little more uniquely strategy, corporate development, thematic research, and some of our cross-portfolio work is part of that initiative. Finance and the risk function report both into the PGIM asset management business, but for our control functions, legal, compliance, finance, risk, we have reporting lines into Prudential as well. But for finance and risk, I also oversee them within PGIM. So those are the direct levers or areas where the leadership team in those areas and I work together. But really the guiding principle is what are the 4 or 5 things we need to get done this year and how do we work together to make them happen?
It's hard for many organizations to have that high level strategy married with that, what I would call hard ops, where actually your day to day is you're just trying to manage the day to day, but it's hard for people to zoom out. I'm curious of your perspective on what makes a good strategic COO.
Yeah, I think the CEO of the future has to be a strategic CEO. And I think you're right. Many people in operations roles, in control roles, maybe the CEO 1.0 model was you had to operate really well at maybe not even 500 feet, Scott, maybe at 10 feet as well. You had to go really deep and granular. You have to go heads down, and that's what got you credibility, and that's what got you promoted, and that's what achieved success. And you avoided trading errors and new risks that impacted your clients or your business. And I think that model is increasingly being superseded by the CEO of the future, the CEO 2.0 model, where it's become an imperative, particularly given the pace of change in the asset management industry and all the new opportunities and new risks that are surfacing, that you have to combine in a much deeper way business strategy and strategic priorities with that CEO 1.0 skill set. And if you just have one and not the other, if you can't operate at both 10 or 20,000 feet and at 100 feet, let's say, you are not going to be as successful as someone who can bring both those skills. So whichever part you lack to be successful in this future model, you have to build that capability set.
And what does that feedback loop look like with your team where you're trying to think about this high level, but you're tying it with execution and you're working with people who are really executing the bigger plan? How does that communication flow work for success?
I think 2 pieces. For strategic CEO who's coming in from the strategy business side, like I did, you have to, first of all, ensure you've got top talent in those particular functions or areas that have deeper expertise than I bring, for example, to a particular fund administration issue in terms of how the interlinkage is working between 3 parts of the business and a third party. You need to bring in the technology expertise that can really look and deconstruct a tech stack and figure out how to build it in a way that works well. So a starting point is really strong operations expertise within the team that a strategic CEO has. Whereas in an old model, I think in a legacy model, you might have had the strategic CEO be that person and then have to make the jump to how to understand and be the 10,000-foot person as well. Second, and you alluded to this in your question, it's the communication flow is key. If you are the conductor, you're not playing every instrument, but you have to hear every sound from the second violin to the drums and the horn. And that requires a constant cadence with the leadership team of each business. And I have weekly meetings with each of my functional leaders where we focus very much on what are the bottlenecks you're facing? What are new risks that have emerged? Against our 5 biggest growth initiatives, what are the resource needs that I can help with? How much of that can be self-fund and how much do we need to make a bigger decision at the PGIM level to find a way to make sure you have the resourcing? One of the biggest risks we have, because we have a pretty ambitious growth agenda, is how can you make sure that our middle and back office and our control culture keeps pace with all the growth that we are entering into new asset classes and new client segments? So that becomes the focus of my communications cadence. And then many other companies, we now use Teams others might use Slack, but Teams, the enterprise instance of that, to keep a constant communication when needed, even in between that weekly cadence. And then we have a process where I'll try and spend time N-2 or spend time with the broader team and understand from them what are particularly some of the issues that are surfacing that are just frustrating and slowing us down, but maybe don't rise to the strategic level. Because I think ultimately it is important to use automation and technology to deal with those as well.
How do you prioritize that? You've got product, you've got geography, you've got talent. How do you stitch it all together to make that operate at a high level?
I think North Star in all this are the 5 or 6 big strategic priorities for PGIM and what moves the needle on those priorities. So that's the first forcing mechanism. The second forcing mechanism is we keep pretty small, lean teams in each area. We haven't overbuilt. And that forces the leadership team in each functional area to self-prioritize. The strategy team simply can't take on every strategic problem that's thrown its way. So it has to decide we're not going to do the nth level of endless competitive intelligence if we instead can dig into the 2 companies that really matter and then focus on execution. I think the third role a strategic CEO can play is in working out the unnecessary parts of jobs. And what are the processes, the reporting that's not needed, again, so you can really sharpen the focus on things that need to happen. And the fourth piece is really linking the businesses and the functions together and really thinking they are really all the business and are all working together to a common end. And that really means every time there's a prioritization decision, talking to our business leaders, bringing them on board and saying, these are 2 different priorities we could drive. We could open a Mexican office or a UAE office or an office in Indonesia. Which one is most important for your investment success, for your clients, and for your business? And really ensuring that none of the functional middle and back office priorities just get derailed or go off track from what moves the business and what moves those 5 strategic priorities. And I think, again, the CEO 2.0 model, by being deep into the business conversations around what matters and then bringing that to bear on all the functional priorities, really helps stitch those 2 pieces together. That can get quite splintered and start going off in slightly different directions. And mini empires can build in functional areas that are serving the interests of perhaps no one.
And then how do you stay abreast of the future? If you're looking 3 to 5 years out, are you doing primary research, secondary research? How do you anticipate where to go, what products, what liquidity? I'd be curious how you tackle that.
One of the big pivots we as a leadership team have made is really building much more external orientation. And certainly in the areas that I lead, one of my objectives for each of my leaders, and I put it down for myself, is that you've got to build relationships with the 5 or 7 COOs, in my case, heads of finance, heads of marketing at the 5 to 7 companies that you admire the most. And obviously, we can't share the proprietary stuff, but there's a lot that's just happening in industry. There's a lot that's happening in terms of clients. There's a lot that's changing in terms of best practices. Technology disrupts marketing or communications or trading. Those conversations help. So outward orientation has almost been baked into the performance metrics and objectives of each of my leaders and myself. David, our CEO, tries to talk to 100 clients and consultants and key parties every year, again, to get that feedback. And then we spend a lot of time benchmarking against top 10 competitor sets, which vary by asset class. And then there's some that are true global diversified asset managers like PGIM around what is the thought leadership or website profile of our competitors looking like? What are they doing that's innovative in terms of marketing or digital capabilities? Should we have a client portal as another way for clients to come on? And how does that compare to what clients are getting elsewhere? I think it's critical. And I think the pace of change in asset management has picked up. And therefore, it's even more important to have that external orientation. And then clearly in my strategy role, listen, I talk to the top strategy consultants and the top 10 investment banks pretty much every quarter and really get a sense of how the entire industry landscape is shifting and is the ground moving beneath our feet and what do we need to do in response to that.
PGIM has this biannual research series called MegaTrends. Can you tell us what a megatrend is and how this research is helpful for investors?
It's a way of taking large structural themes that are changing the world and changing the investment universe and changing the investment opportunity set and creating growing obsolescence risk in portfolios where no one wants to be the dinosaur portfolio. But these big structural themes, I'm thinking urbanization, I'm thinking aging, I'm thinking new labor force dynamics, the re-rise of trade unions in the US to how do you bring female labor force participation into emerging markets? Our next report is on the new energy landscape. But we take these big structural themes, and our unique aspect is the ability to go to portfolio managers who may not be running an urbanization fund or a demographics fund. In fact, we don't do many thematic funds at PGIM, but those long-term trends, as we are typically long-term investors, underpin many of the investments they're making or many of the investments they choose not to make. And often where they choose not to make is areas where there's tons of media hype around this is the next golden goose. And we have the ability to bring those multiple perspectives together from real estate debt, real estate equity, agricultural debt, private equity secondaries, private credit, direct lending, fundamental equity, fixed income, the quants, and now most recently, a multi-asset solutions perspective. And in a single place, give a chief investment officer or someone who's looking at multi-asset portfolios a perspective of the most recent and best thematic views on how we are playing that particular trend or what we are avoiding across all the asset classes. And that combines with much deeper research in single asset classes that our research teams and the businesses do. But that really was the point. And then what's neat is, since we now have 10 years of these trends and many remain very valid themes, we've created a digital way that somebody who's just in equities, just in fixed income, just in private alternatives can go in and say, for each structural trend, what applies to my asset class? And you can do that by region as well. And obviously that took 10 years of accumulated data on investment ideas, each one of which our portfolio managers either invests in or is thinking about investing in. And I think that's the unique element of the megatrends.
And how do you pull that together? Because I would think that at some level you have talked about this with energy, and there's an opportunity for alpha, but also you need to be careful what risks are actually going to surface as a result of this opportunity, maybe in another product sector region. How do you extract that information that could be coming from different areas within the investment organization?
First, we have a team that steadily looks at all the macro data, and often we partner with third parties. We also talk to about 10, 15 experts. For our new energy paper, we've been talking to folks at the Department of Energy, to venture capitalists, to private equity firms, to academics who spend a lot of time at it. We have lots of conversations with Brookings and people across the political spectrum who can give their perspectives on how they interpret the data. And there's some exciting insights that I think ultimately everybody agrees with, and those are the foundational building blocks. So for example, in energy, no matter where you are on the so-called green divide, when you take a pragmatic, rational view at the fact that how humans live, you will need both fossil fuels and renewables for at least the next 3 to 4 decades, because the unpleasant arithmetic of the distance between energy demand and renewable energy supply means that fossil fuels will remain a critical piece of this. The data is also incontrovertible that while the cost of renewables has now become lower than fossil fuels in providing electricity, many things still can't be electrified or still many years away from being electrified. It's also very clear that multiple decades of building an infrastructure for fossil fuels, for planes, for cars, is not going to happen overnight in renewables world, and much more investment is needed. And probably there are real private sector opportunities, and we highlight them in various parts of the renewables ecosystem. Equally, there are parts of this that get a lot of press attention. Carbon capture would be one of them. We did a paper on the food system last year, and alternative meats was another one of them. But they're always areas which are good ideas, Scott, but they're good ideas not for investors. They're good ideas often for governments or foundations to invest in, because it's still way too early for the investment thesis to be clear enough for a private sector investor who has a fiduciary duty to go in. And in energy, we highlight a whole bunch of ideas that have been paraded as miracle solutions. And there are either too many people doing it, so it's too early for anybody to go in and pick a winner to put in a portfolio, or it's just so uneconomic at this point that it is in a state where you need the primary research rather than the secondary opportunities where private sector come in, and there are profitable ways to then grow the business. And we really find a lot of those, and I think our clients find it very useful to separate hype from reality around what can be done. The third and unique element, energy report again, but is being very pragmatic. I think some policy goals, some regulatory goals, particularly in the energy meets climate space, are really pie in the sky and fairly unachievable. And we say to all the clients who do still want to make progress, here's a much more pragmatic, granular, real-world way that an actual practitioner can make progress rather than getting lost in goals that might be lofty and worthwhile, but maybe impossible in the reality of the data that exists and what's doable. Another good example there would be, I think it's easy to paint the world in energy into brown fossil fuel villains and green heroes. We present a much more nuanced perspective around the fact that what we call the khaki companies, the greener side of brown, there's a lot of change happening, and those companies have huge incentive to be part of this transition, which is happening already. It's been happening for 2 decades. You've been seeing fossil fuel use decline and renewables increase, driven just by capitalist forces and the cost of renewables these days. How can you participate both in changing those companies and participating in the growth that's coming within the fossil fuel companies from companies that are at the leading edge rather than the lagging edge of where the world is going?
Yeah, there's a lot of trade-offs with every growth. You look at the electric vehicle sector and the growth there, there's trade-offs on production, there's trade-offs on just infrastructure. How do we meet the demand? But that's a story for another day. And then it also feels like the work that you guys are doing, it makes an organization like PGIM nimble. I was looking at one of the reports and it just felt as though you just provide so much information and rich context to actually help organizations be able to think about what's the next sector, or how do I look out in order to anticipate. There was a lot of press on semiconductors this way, but that's been going on for 30 years. You can anticipate the growth in gaming and all these other things. It's providing that leverage to our clients is really powerful.
Yeah, we did the whole e-gaming section a while back. We had a more negative view on virtual reality because ultimately people want to talk to other people. And at least in that generation of VR, it's been in hard. It may change. And we're pretty honest about going back to our reports and saying which of the particular investment themes didn't quite play out the way it was meant to. And maybe one good example was when we did the urbanization report many years before COVID. We talked about more denser, smaller units in cities. And as you know, everybody now wants the courtyard or the suburban life. I think cities, despite all the angst that existed a couple of years ago, are still thriving. But suburban life, courtyards, a different kind of lifestyle has taken on. So we are quite honest where things didn't quite play out. But many of the themes, I think, have played out the way we thought. A very interesting report we wrote only a couple of months after the pandemic was what's going to happen. And many of those themes that we talked about well before they played out on Vietnam and Bangladesh and Indonesia and nearshoring and friendshoring and bringing stuff back and how automation will play out exactly that way.
Yeah, trying to anticipate what shocks coming to the system is a very tall order to repeat. You can do it once, trying to do it twice is difficult.
I do think it is interesting as a CEO to think about what are the opportunities with the parent. And in our case, we have an insurance parent with Prudential. And I think, again, in terms of your point around thinking about what's next, the rise in interlinkages between private alternatives and insurance has created a whole new set of opportunity where I think we have a bit of a comparative advantage that we have a in-house insurer and deep liabilities expertise to combine with all our private alternatives expertise to really go after solutions in the insurance space. So I think the CEO's role is also in the 2.0 model. What's coming next? And what are some of the in-house capabilities that I may not have traditionally used that now become key? We have always used and partnered with our insurance company, which remains our largest client and has been just a tremendous partner in terms of seeding and anchoring some of our new capabilities and strategies. It's great to have permanent capital in-house, but this whole move between the interaction of private equity, private alternatives, and insurance has created new opportunities.
Given the merger activity, I see a lot of more liquid asset managers acquire private markets to provide different revenue streams, stickiness. The key question is going to be, how does one partner with leadership to actually see these opportunities and connect these leverage points for growth?
It's absolutely essential to have that dialogue open and maybe make sure people don't kill ideas too soon, but find ways to keep them going, have the discussion. And here we did it successfully, but it has also increased complexity. And certainly going into the insurance space adds complexity. But within PGIM, it means structuring and how do you create capital efficient vehicles. It means another regulator to think about. But more broadly, I do think complexity in the CEO role is going up quite dramatically for large global asset managers who work across alternatives and traditional asset classes.
My experience is that trying to stitch together, you have private markets, you have liquid strategies, you have the wealth sector. You look at the amount of Main Street buying private markets more in the accredited space and the qualified space. And it's really hard to be everybody, but meet everybody's opportunities and demands, but trying to stay on top of that and anticipate where to go, who to partner with, what skills to build. It's just an ongoing challenge for sure.
I think one of the reasons our mantra of depth and scale it's not depth or scale, has really resonated both with our employee base and with clients is the case for scale in certain areas has become so much more important. The regulatory complexity and the divergence between what different regulators across China, Japan, the EU, post-Brexit, the UK, and the US have on issues. ESG is probably the most striking example of regulatory divergence, but on many other things as well. Different regulators are working in different directions. And as we grow globally, understanding that regulatory landscape, what is Brussels thinking? What is the Japanese FSA consider best practice that we should try and emulate? What's happening across US states, let alone federal agencies, has become much more complex. The compliance frameworks that you now need to market into different geographies and the pace of change of regulations and keeping abreast with that has become much more important. To your point, with the democratization of alternatives into the high net worth and retail channels means suddenly you need to develop expertise in BDCs and REITs and interval funds. I feel in some ways it's quicker than what it's doing to, say, a private credit shop on the investment process or even a fundamental fixed income shop. It'll come there, but right now I think it's really has the biggest bang for the buck and change in the middle and back office of companies.
Is there any one thing that worries you the most?
I think regulatory complexity would be very high up the list for anybody who operates in multiple jurisdictions and the degree of regulatory divergence.
How do you think about building a team or hiring for your particular organization?
I think it starts with culture. You want people who have the right value systems, people who have good cultural fits with the goals of the organization. If that doesn't work, I think everything else fails. At PGIM, I found really deep subject matter expertise counts for a lot. You can't market your way in any functional role to success and credibility with investment professionals, with the front office organization, if I can use that term. You really need deep expertise in your area. I certainly look in my case for external orientation and people who've either come from other peers that I admire or who have a network of understanding of how the broader world works. I think at a large asset manager, you can no longer be US centric and have only US experience. You've got to have an understanding how different cultures and markets and regulators work and really take a global mindset to your work. And obviously, I look for lots of evidence for collaboration, which comes as no surprise, given connecting the dots is so key for us. Somebody who can work with a team, can hand off and pass on. Those are, I think, the 5 skills that I look at the most. And then obviously, we ensure that they're great team leaders because in CEO roles, often pretty large teams and just quite easy, particularly in operations, I think, to get stuck in a role where you have no chance of progressing, or in our structure where each manager has their own embedded technology team. For the top technologists, where do they travel? Where do they go while still retaining them within PGIM? So creating those pathways for progress, leaders who are tuned to finding those, leaders who can really take ops people and make them feel more connected to the business so that when we do our engagement pulse surveys, they feel connected to the business strategy and so on. People who can inspire, I think, are important. So it's not easy to find the right talent. And then when I find that talent, I think we do everything to retain them. We will give them the flexibility, the space, the resourcing, the support, the opportunity set to make sure that we keep them. Because particularly in a multi-manager at the center, navigating the multi-manager model, allowing depth to be deep, building scale where it makes sense, building consensus, offering the menu rather than a forced choice, that requires a very unique skill set. So when we get the right people, we really invest a lot of time in making sure that they're having a fulfilling, engaging journey and they're coming in energized to the office every day.
Do you feel as though that's been a shift over the last 10 years, moving on to that flexible approach where you're actually empowering people?
I think the recognition over the last, and I think your 10-year horizon is exactly right, has been that technology is going to change operations radically. So you need to link those two. You can't have them completely separate. I'm sure there's some clever quip around software eating operations, but you actually need a lot of operations expertise, but you have to use technology to enable that expertise and leverage it and make it more productive. But even more importantly, I think there's now a widespread understanding that technology is not going to disrupt the technology sector. It's not an IT sector in the S&P that's going to be disrupted by technology. The greatest disruption will happen in all other sectors. It's coming to every single asset class and changing how investments are done, how trading is done, how you interact with clients. So I think that's meant that the CTO who often wasn't on the business executive leadership team, who might have been quite removed, has to be integrated, I believe, for the success of that business into those decisions. And the biggest frustration points, as well as the success points for most of our businesses, and as I talk to my industry peers across the industry, is increasingly, how can I make technology work for me? How can I make operations work for me? How can I create a control culture that both protects me from risks, but also allows me to take the right business decisions? And that requires really a single team. We've used, I think, almost artificially this term around front office and back office and middle and back and front. It's really all the business, and it's all trying to create great client outcomes, because that's what ultimately creates business outcomes. And you can't do it in silos. But I think it's not been hard to do, given that it's now widely accepted that whether it's happening in 5, 10, or 15 people might dispute the time horizon. Technology is no longer just a service that you take and move on, but integral to how you run your entire business.
Taimur, thanks for the time. This has been really a wide-ranging conversation, as well as deep in a bunch of areas. I have one closing question. What resource do you most often refer to others? Could be a book, blog, podcast, newsletter.
Well, obviously, it's capital allocators, Scott. What else? No, seriously, you guys do an amazing job of really bringing investment insights to all of us who follow along. And I really like the fact that you're covering operations in addition to the CIO's dilemmas that Ted covers. I'd say a couple of things. One, the media is now so polarized and so divided that I really get a lot of really partisan and unhelpful views from much of the media. But two places where I go to quite often, and they're probably more, is the Financial Times and Bloomberg. So I would say everyone, even if you're not in an investment role, even if you're quite removed from that, those are places where to get an understanding of businesses and investing are great places to go. I'm a big fan of the Odd Lots podcast on Bloomberg. I think they pick quite quirky topics, but what I like about it is that they truly geek out and go really deep into shipping routes or canned salmon in Alaska and real estate debt in the rent stabilized market in New York. I think it's a fascinating place. And then I'd recommend 3 books. One is Peter T.I. just finished Outlive. This is not about trying to live till 200, although bless you if you want to. It's about while you are living, how can you have the longest health span? And in a world full of lots of books full of anecdotes, this is one that's data-driven and will appeal to people with a tech operations background, a data-driven background to really dive into. And I learned a ton and shared it with my GP, and we're doing a few things differently in terms of just testing and his idea of preventative medicine rather than after the fact. I've begun reading Chip Wars by Chris Miller, which is at the heart of semiconductors, and particularly with the new CHIPS Act and the rising geopolitical tensions. I'd say that's a book everybody should read. And then for those who are into technology and AI and veering into fiction, Shiguro wrote a book called Clara and the Sun, which is about the near future and told from the perspective of a robot helper to a household. That is both beautiful and touching, but at the same time, really, I think, opens some questions that we all need to ponder about the near future and how we'll coexist with AI.
Taimur, this is excellent. I've got a little reading to do. Thanks for everything, and let's stay in touch.
Absolutely. Great to have the conversation, Scott.
Thanks for listening to the show. If you like what you heard, hop on our website at capitalallocators.com, where you can access past shows, join our mailing list, and sign up for premium content. Have a good one, and see you next time.